Welcome back to The Long Short, the podcast that brings you the biggest ideas, trends, and strategies shaping the world of alternative investments. I'm your host, Tom Keogh.
And I'm Drew Nicol.
So if, like the team at The Long Short, you have been following institutional investing trends, you might have heard the term portable alpha resurfacing in conversations among hedge funds and investors.
And resurfacing is the word because this is not a new development. In fact, the strategy has been around for decades, gaining serious traction in the early 2000s with institutional investors like endowments and pension funds jumping on board.
And then, of course, came the 2007-8 global financial crisis, and portable alpha didn't just fall out of favor, rather it became a cautionary tale.
Fast forward some 17 years and portable alpha is back.
So what is it? Why are investors falling back in love with the strategy, or did some never go away? And what's different about the portable alpha of the early 2000s and what is being implemented today?
Here to tell us more about all of this is Anne Marie Fink.
Anne Marie is the Chief Investment Officer, Private Markets and Funds Alpha at the State of Wisconsin Investment Board.
In addition to her role at SWIB, she's also co-chair of AIMA's Global Investor Board, a strategic advisory group helping alternative asset managers stay ahead of investor trends and shaping their asset allocations.
Yeah, and since its inception, the GIB has delivered cutting-edge insights on hedge funds and alternative assets, helping to bridge the gap between investor and manager expectations.
And of course, those of you who attended AIMA's annual Global Investor Forum in Toronto earlier this year will no doubt have seen Anne Marie and other members of the GIB speak.
Anne Marie, you are very welcome to The Long Short.
Glad to be here. Thanks for having me.
So let's start with the fundamental question then. For anybody that was not around in the early 2000s, what is portable alpha?
So portable alpha is a way of thinking about building portfolios that really separate the alpha and the beta component. So if you think about traditionally what investors have sought to do is they've invested in active managers that give you exposure to a beta or a market exposure plus some outperformance or alpha. What we're doing in portable alpha is we're separating those two. So we're getting our beta or our market exposure in a much less expensive way, mostly using futures, and then using some of that capital to invest usually in hedge funds or some sort of strategies that are more pure alpha oriented. And in that way, by combining them, we think we can get an overall package that is more attractive than the traditional way of long only with some alpha.
So how do you put this all together then in terms of how is it done in practice?
So what we're doing to get our beta exposures is we generally are using futures. So that means that we don't have to put the capital out necessarily. I mean, we have to put some margin, and we do have to fund it at effectively a cash rate. And then we're going out and we're trying to find hedge funds that can give us performance that will beat that cash rate, because that's the cost of putting on the market exposure, and can do so without taking undue market risk. So where they're really doing it through alpha, through outperformance, either long short strategies where we're going long and short, very little market exposure, but if our manager is doing a good job of selecting both the longs and the shorts, they can deliver performance to us. So things like that.
So you mentioned one option there of where the alpha portion of this might come from, but can you just expand on that a little bit about the types or the places where the alpha portion of this strategy can come from, and just generally help us understand how that's generated?
Yeah, so I think different people do it in different ways. We actually at SWIB, we take a somewhat broader view of it. So some of the strategies that we use are long short. We're typically looking for folks that are going to be relatively low beta or very little market exposure, but we're not dogmatic about it. So there are some people that will do portable alpha and say it has be 100% market neutral. We're a little bit looser on that constraint. Other places that we do a lot of fixed income relative value, which is also another strategy where you can get a lot of, you can generate some alpha while not taking market direction risk. And then we also add in, we have a number of multi-strats in our portfolio, and then we also do some macro. Now, the macro managers are taking some directional risk, but it's not consistently in the same direction. And we're really looking for macro managers that can build an asymmetric profile. So if they're right about the direction of a particular macro factor, they will make a lot of money. And if they're wrong, they're just going to lose a little bit of money. So we're looking for people that can give us that alpha through either trade construction or how they manage their books.
So we've talked about some of the benefits then of using portable alpha, but what would be then the risks or some of the primary concerns then associated with portable alpha? More importantly, how can these be managed?
Yeah, so there's a number of risks, and as you sort of foreshadowed, Tom, many of those risks came to light in the early or the late 2000s around the financial crisis. So one of the risks is that you're not picking managers that are very actually alpha oriented. So if you're letting some beta exposure or some market exposure bleed into your portfolios, then you're actually doubling down, right? Because you already have your market exposure separated from your portable alpha. But then if your portable alpha is giving you a bunch of market exposure, you can, when markets are going up, that's going to be great. But if markets go down, you're going to get hit on two sides. Another risk with portable alpha is you are counting on your managers to deliver alpha. And again, in the construct that we use, they have to not only deliver alpha, they have to beat the cash rate to fund the cost of the futures. And so you certainly can imagine managers that can't deliver that. So manager selection, so making sure your managers don't have a lot of beta, manager selection, that they can deliver the performance that you're looking for is another risk. And then the third risk that I would mention is deleveraging risk. So if you have a situation where the markets are getting a little fragile and primes are pulling lines and people are having to deleverage, often what you'll see is shorts go up as people are taking off short exposure and longs go down as they're taking off long exposure. And so those deleveraging moments can be a little tricky because it's very hard in those situations for your funds to deliver that alpha that you're looking for.
It's interesting that you mentioned deleveraging there, because I wanted to ask you just about plain old-fashioned leverage risk as well, because again, in my research around this, as admittedly someone that was not around in the early 2000s, the concern around just plain old how leverage can go wrong, as in doubling down on your losses, also seemed to feature in some of the prognosis of everything that happened. Is that, have I read that correctly?
So yes, so leverage to me is a very interesting word because it means different things in different contexts. So at the most basic, yes, you're levering, right? So you have market exposure on your beta, and then you're usually putting, I don't know, 80 to 90% more exposure. It's not hopefully market exposure, but you're putting more exposure by giving money to hedge funds to give you the alpha piece. So you could argue you have gross exposure of 180 to 190 for every dollar that you have available. So it's certainly leverage from that aspect. The reason I say it needs to be a little nuanced around leverage is if you think within the hedge funds that we're giving money to, they also are levered, right? So they'll have, if you think, just to use the simplest example, a market neutral long short fund, you're 100% long, 100% short. That is also, you could argue, 200% leverage, right? Because you've got gross exposure of 200%. The reason that is a different type of leverage is that you don't need to generate, you don't have to pay that back necessarily. And hopefully your long and your short are matched so that if the market goes up or down, you're not losing money, right? You're just losing. So it's just if your longs are not outperforming your shorts, that is the risk. So it is leverage, but it's not, it's a little bit different or nuanced to me relative to something where you borrow money and you have to pay back the money regardless of whether something's working or not. This is a little bit more hedged in terms of if it doesn't work, or the odds of it not working are more idiosyncratic than it in something that's pure leverage.
So, Anne Marie, we talked about it a little bit, but obviously this was a strategy that came to being even before 2000s, Drew. Actually, there was several decades before. I think it was the 1980s when it first came out. Was it Myron Scholes that developed this strategy? It came into vogue and certainly became increasingly popular in terms of the potted history around it in the early 2000s. And then we had the situation of 2008 when, as I said, very much became that cautionary tale of finance. But now it's the comeback kid, or certainly it seems to be in terms of conversations that we're hearing and events, any investor events that are taking place. People are talking about portable alpha again. You'd be forgiven to think that it wasn't the early 2000s again. So why, Anne-Marie, are we seeing this renewed interest among investors in portable alpha? Or I put to you, maybe that interest never really went away. It just it subsided somewhat.
Yeah, I think it did subside somewhat. I will say at SWIB, we've been doing it for about 8 years,
Yeah.
so it's not that new for us. I think there's a couple reasons that it's very popular right now. Or actually, I'll say three reasons. One, I do think people have gotten more sophisticated about understanding the underlying risks within their hedge fund portfolios. And you have a lot more hedge funds that are really have less market beta than you had in the early 2000s. So I think that understanding that if I'm doing portable alpha, I really need the alpha piece of it to have alpha and not be beta in disguise. I think that's one reason, is that you've got a lot of options right now to do that. So that's one reason. I think a second reason is the concentration that you're seeing, particularly in the equity markets. So if you think about what's going on with the Magnificent Seven stocks, that makes it if you're a long only manager, that concentration makes it almost impossible to deliver outperformance because you have to put so much of your exposure into those large stocks. And not only do you have to put a lot of exposure into them, they're actually the thing driving the market. So if you wanted to be overweight those 7 stocks, there's room in your portfolio for almost nothing else. So with portable alpha, you take away that constraint because you have the beta that gives you the exposure to those that concentrated index, and then you can do the alpha completely separately. So you can find stocks or bonds or instruments that'll outperform and ones that'll underperform, and you're not bound by that constraint around how concentrated the index is. And then I think the third reason is that with cash rates being much higher now, short rebates are actually a thing. So hedge funds now can make money off of their shorts, which helps to cover their fees and their management expenses. And so it's just, there's a lot more opportunity, we think, right now within the hedge fund space. So the longs and the shorts are interesting.
So just to ask, again, maybe the other obvious question here is that given we are talking about resurgence at the very least, if not a total comeback, how are hedge funds and, in fact, institutional investors approaching portable alpha differently today than they were in its first and second go-round?
I would say what I mentioned earlier is that I think investors are just much more focused on understanding the drivers of their hedge funds And are those drivers basically doubling down on the market risk that they have, or are they giving them true idiosyncratic returns? Certainly, also, I would say the rise of the multi-pad funds has also created a lot of opportunities where there are funds that are really very risk managed and not taking a lot of market exposure and can deliver that alpha. So that's another reason there's just a lot more availability of hedge funds that are giving you the characteristics that you need to implement in a portable alpha construct.
And Anne Marie, we talked about endowments and pension plans, I guess, would have been the types of investors that would have been most familiar with portable alpha. Has that landscape changed in any way? Are we seeing other investors now looking at portable alpha? You mentioned the multi-manager platform that's looking to incorporate elements of portable alpha and deliver solutions around that, but they would cater to a different or a wider landscape rather investors.
Yeah, so I think the multi-platform or the funds are ones that are used by allocators
Yes.
in portable alpha constructs. In terms of your larger question, we are seeing a lot of people. I would say your bigger, more sophisticated people who can do the analysis to understand what is in the hedge fund book and is it really delivering alpha and idiosyncratic returns that I can marry with the beta that I've added. Certainly the Australian supers are doing a lot of it. We're seeing the Canadians do a lot of it. And then even a lot of the Middle Eastern groups are, so the sovereign wealth funds in the Middle East are doing it as well. So it has become, as you said, reasonably popular, though I think generally with people that have a little bit more staff to manage some of the complexities.
Can you just say more about that? Because from a regional point of view, I find that really interesting. And maybe you just touched on the answer right at the end, but what is it about those sovereigns that are leaning into portable alpha? Is it just a case of having the capacity or
I
risk
think
profile?
uh, I think it's the capacity, it's the staff capacity, right? So you have to manage your beta exposure. So you have to have somebody who can manage your futures and the roles and everything that goes with that. And then you really need to avoid the mistakes that were made in the mid 2000s. You really need to understand what your hedge fund portfolios are doing, and are they going to deliver that alpha for you, or are they going to just compound the risks that you have in your beta exposure? And that's understanding that's really important, and also understanding where, to the point earlier, you do have on a lot more market exposure. You have a lot more exposure across the board. So you really have to watch that exposure and make sure you're not going to get certain risks that are going to come in that are just going to compound and create problems if you have a downturn.
The AIMA Global Investor Board acts as an advisory body to help managers better understand market trends impacting alternative investments, highlighting investor expectations for managers to improve alignment and elevate industry sound practices, all while enhancing stakeholder investment outcomes. Co-chaired by Edward Van Gelderen of FCLT Global and Anne Marie Fink of State of Wisconsin Investment Board, the GIB features 22 leading institutional investors from New Zealand, Brazil, Japan, Australia, Sweden, England, Canada, Abu Dhabi, USA, Hong Kong, Saudi Arabia, and Singapore. You can check out GIB perspectives on hedge funds, private credit, liquidity management, total portfolio approach, ESG, and more at ama.org/GIB. You can also email the GIB your questions confidentially at agib@ama.org.
So just to help bring this to life for listeners a little bit, could you give us a real-world example or a case study of where Portable Alpha has provided the really notable returns that it sounds like it can do?
Yeah, so it's been a huge contributor to the returns that we've generated at SWIB. So if you look over the last 5 years, our hedge fund portfolio, which is this portable alpha construct, has generated about 1.4 billion in returns. And that is over and above the cost of financing to put on the beta exposures. So it's been, and we've had, I mean, it varies over time, but we've had about 8 billion or so to work. So it's been a pretty meaningful contributor. Another thing I would add, at least the way we do portable alpha at SWIB, that's been very helpful is because it's an overlay and it's not actually technically part of our portfolio construction. So the betas are in our portfolio construction, but the alpha or the portable alpha piece of it really depends on what we find in the market. And so what's great about that is that it means we can be really responsive. So if we find a lot of opportunities that we think can generate that alpha for us, we can go and put it on. And then if there's times when the alpha opportunities are less interesting, we can actually shrink the size of our book. So we use that portable alpha. It's really dependent on what we can find from the bottom up perspective.
So we've talked quite a lot about how the market environment today, or the macroeconomic environment today, may be contributing to the resurgence of portable alpha. But is there anything else, sort of from an operational or technology side of things, that's also contributing to this trend?
So I think the ability to evaluate hedge funds has gotten much better in terms of understanding the idiosyncratic relative to the beta exposures or the market exposures that you have. Another trend that we've seen or that we've kind of leaned into recently at SWIB, and other people got there before us, is around the managed account platforms. So we initiated a managed account platform about a year and a half ago. And that's been really helpful because we're on a managed account platform and we have about a dozen managers in there, and we can see what they're doing every day in the middle of the day. So that's been very helpful to us to understand the risks that we have, and it allows us to work with managers that, because we have that visibility, and a lot of that visibility is related to the technology being better, as you referenced, Drew. So we have that visibility. We can take some more risk with managers that are maybe less established, and it just opens the universe of funds that we can work with within our portable alpha construct.
So, Anne Marie, then to take this conversation full circle, we've talked about the renaissance of portable alpha. So, given the uncertain macroeconomic and geopolitical environment that we're experiencing, you've also alluded to the Magnificent Seven and the huge influence that they have on equity markets. Are we likely then to see increasing interest then in portable alpha strategies?
Probably, right? Yeah, I think there's a whole host of reasons why the strategies make sense. Magnificent, or the concentration being one of them. Two, I think the universe is much better. So you have a lot more hedge funds that are much more aware of the risks that they're taking and really focused on idiosyncratic risk than you had, 15 years ago. And I think the investors are getting more sophisticated as well. So when you put all three of those together, I do see a bright future for portable alpha.
And these are conversations that you have at the AIMA Global Investor Board level. And we are now putting out notes on our website as well, and observations not only on this, but on ESG and various themes that are impacting our industry. All of these are relayed on the AMO website. Anne Marie, thank you so much for your time. We have only just barely scratched the surface on this very important topic. And as I said, it very much is the comeback kid when it comes to our industry and strategies that are coming back into vogue. So thank you so much. And hopefully we'll have you again back on the show in the future to talk about more themes and trends.
Thank you.